Welcome to We Build Great Apartment Communities, the only show dedicated to the process and strategies for transforming apartment buildings to thriving communities. I am your host, John Brackett, and welcome to the show. All right, folks, welcome to another great episode of We Build Great Apartment Communities. I am your host, John Brackett. I have another great guest. This is Matt Shamus, someone who I'm very excited to have a conversation with, kind of a unique background. Someone who started off in real estate and transferred over to tech at Facebook. And so I'm really curious to get into the conversation of how tech has helped drive his business. But Matt is no newbie to real estate. He's been around for a while. And we're just talking about, prior to the show, him acquiring I think it was a 75,000 square foot industrial building in Milwaukee. So Matt, welcome to the show, bud.
Thank you. Thanks for having me, John. I appreciate it.
Yeah, you're very welcome, man. So I'm going to introduce you to our audience really quickly, Matt. Invite them into this conversation. So Matt, you are the co-founder of Driven Capital Partners, which is a diversified real estate private equity firm with a portfolio totaling roughly about 9 projects and about $90 million in value. So Matt started Driven Capital Partners to invest his own capital in high quality commercial real estate in U.S. growth markets. And Matt has enjoyed a successful entrepreneurial career spanning from finance, real estate, technology industries, and including a 6-year stint at Facebook. So Matt, welcome. And man, my first question is, tell me a little bit about your background and how you got into real estate, for that matter. And I know you invest in different product types, meaning different asset classes within the real estate industry. So, give us your background, bud.
Yeah. So, well, I guess I would say I'm more kind of an entrepreneur generally that has a keen interest in real estate. And I actually get quite a bit of just kind of flex some creativity or creative muscle through real estate. So I've had this kind of entrepreneurial career. Real estate has always been a part of it to some degree. And I started in finance, underwriting businesses, helping businesses raise money, mergers and acquisitions. I ended up starting 2 technology companies and selling both of those. And then after that, I went to work at Facebook and worked on the original Facebook for iPhone app. This was back in 2012 when this big transition to mobile, and that was really kind of a key initiative at Facebook. And really, kind of Facebook was certainly a big company, but has grown tremendously since then.
Yeah,
I thought I'd be at Facebook for a couple of years, turned into 6 years, but throughout my career, as soon as I started making a little bit of money, I quickly invested it in real estate. And originally, kind of did what a lot of people do, which is you go to an area that you know well, you buy a little rental property. And what I tried to do was buy the kind of the worst house in a decent neighborhood and improve it by renovating it and turn it into the hopefully the nicest rental property available in the area. So I did that a bunch. Started taking money from friends and family and coworkers, and the side hustle turned into this thing that was feeding me more than my day job, was feeding my kind of entrepreneurial spirit, was definitely feeding my creativity. And also at some point I approached this moment where I was making more money and having more fun doing real estate. And so that began kind of this transition to doing it full time. So my partner, Dan, and I started Driven Capital Partners in 2018. And the bio that you provided is just a little bit outdated. That's probably my fault. But that's also just a function of us, moving fast and growing our portfolio, growing our investor base, and doing doing things that we enjoy doing, having fun.
Awesome, man. Awesome. So what were some of the big takeaways that you were able to extract out of your Facebook, years and apply to your real estate business?
That's an interesting question. Well, I mean, so I guess one thing would be to move really quickly, and you're not going to get everything perfect. In real estate, we have these slow transaction cycles. So what I like to do is put a lot of opportunities into the top of the funnel, give each of them a little bit of attention as we learn more and more about each opportunity. Some of them naturally get filtered out. They don't pass the bar. They don't make sense.
Right.
And a very few of them trickle down kind of to the bottom of the funnel. And by that point, we've spent a fair amount of time and energy understanding what the deal is. And what that has allowed me to do is just have this kind of consistent pipeline of opportunities. And you have if you have the chance to say yes at the end of the day to the ones that you're interested in. I think Facebook was still is a place where you have really talented people and people that are really motivated to do good things in the world. And that left an impression on me. There's a lot of really, really good people there, both in terms of competence, of course, but also just in terms of character. And so I think that was something that I certainly take with me. I think thinking bigger, thinking a little bit bigger about things at Facebook. If it's not $1 billion opportunity, it's not even worth considering. It just won't make it past very low levels of consideration.
Sure.
So I think thinking a little bit bigger. Those are a few things that come to the top of my mind.
Well, I really appreciate you sharing that. So, in the world of private equity, and reading your bio, that's really, it sounds like how you're positioning your firm forward. So in the world of private equity, when you talk about thinking bigger, what is the vision for your company moving forward, especially with some of the learnings that you're able to extract from Facebook and, of course, applying that forward, right? But where do you see yourself in a couple of years relative to what's going on today, especially as a private equity firm?
Well, our job is to go find really strong risk-adjusted returns. And so that's what we go look to do. Now, the global environment around us is going to dictate a lot of what the opportunity is. The multifamily world over the last, I don't know the exact years, but approximately maybe from, call it 2010 to 2018, 19, has seen, if you were an investor in a multifamily deal, even if it didn't do well, even if the deal was executed mediocre, you still probably had amazing returns. And just the whole industry kind of did very, very well over that time period. I don't think the days of tripling your money in 2 years on a multifamily deal are still here. I think that ship has sailed. So a risk-adjusted return in 2014 is going to be different, and you might need to deploy, funds in a different way in 2020 and beyond. So I think one of the things that we do is look very critically and opportunistically at where do we see risk-adjusted, positive risk-adjusted returns or strong risk-adjusted returns, and how do we position our portfolio to take advantage of the trends demographically, economically, otherwise that we think are really important. So to give you an example, or to make this a little bit more concrete, where we are today with the pandemic that we're all living through, and by the way, I'm in the Bay Area, and I don't know what it looks like for you today, John, but the sky is like golden, yellowy orange.
I'm sure it is for you folks up in Northern Cal.
It is the weirdest thing. This is like, it's apocalyptic. It's one of the weirdest days I've ever seen. But it's a good example of all the things going on in the world right now, which create uncertainty. And to me, uncertainty points to a position where you take risk off the table. So with that in mind, what we are doing with our portfolio and where I see kind of our business moving is we have 2 deal profiles that we're acquiring. One is steady, consistent, high cash flow, kind of boring deals. They're going to have low upside, but they're going to be very consistent in terms of cash flow. These are generally industrial assets with triple net leases, in really stable markets, generally in the Midwest. And we're talking about, somewhere between an 8 to 10% cash on cash return. That's very, with sticky tenants and just kind of consistent, stable income. And the other deal profile that we're acquiring are really, it's kind of the other end of the spectrum, really heavy value add multifamily. So, and we generally like areas that have very low cap rates, supply constrained, and have relatively high rents. So Santa Barbara, California is actually the market that we like most for that particular strategy. Multifamily assets, trade in the 3 and 4 caps. So when you can add value, you can extract a really meaningful amount of value once you've added it and you look to go sell. So those are the kind of the 2 deal profiles that we're looking for and that we're currently acquiring. And our goal with this business, Dan and myself, our goal is not to create a huge business. We don't have an intention of building a business with 100 employees. What we want and what we started this for is to own high quality real estate, to work with people that we enjoy working with, to take on projects that are going to be challenging and exciting and really satisfying and gratifying. So really it's more for us about doing the right projects and working with the right people that we're aligned with, and not growing for the sake of scale. I think that's one thing that maybe is a trap that some people fall into. To me, scale is not a goal in and of itself. It certainly can be helpful to get you to a different place,
right?
New level, but that's not really what we're doing. We're really focusing on quality assets and quality relationships.
Okay, awesome, man. So let me kind of unpack what you just mentioned about the 2 profiles, right? So one profile, industrial product, you're going for yield. In theory, a more stable asset class, right? Especially in a market like this. And then the other, especially if the objective is to pursue and secure triple net lease type product, right? So the other side of that too then is, you talked about heavy value add properties, in this case, multifamily product, in high density, low cap marketplace, or in low cap markets. Yep. But usually those 2 kind of go in opposite direction, right? So talk to me, give the audience an example of what that would look like in Santa Barbara. Because in my mind, what you described is like a reposition from multifamily to student housing, right? I mean, that would be an example of that extreme type of value creation, especially in a low cap market like that. The other side of that, which is what we do in high density markets, is we find product to reposition or build, right? Land that's being underutilized, that we build, kind of what I was talking about earlier with our project. Yep. Here. So can you kind of elaborate on that a little bit, just to give some further strategy? Yeah.
So in Santa Barbara, you have 2% multifamily vacancy, which is, if you just think about that for a minute, 2% is really just people moving in and out, changing their address. There's really not any vacancy in the market. And there's all sorts of reasons for why, but a couple are, it's very, very expensive to build there. And there's geographical constraints with the ocean on one side and mountains on the other. So there's just not a lot of development of multifamily going on in Santa Barbara. We have a project there it was an office property that we are converting to multifamily. So we're using the California State Density Bonus Program to get 23 units in what used to be a 17-unit suite office property. It was actually built originally in the 60s as multifamily. It was added onto and then converted to office in the 80s. Owned for a long time by a family that in a trust, and just kind of, like a lot of people do. It wasn't, you're managing to occupancy as opposed to getting the highest and best use out of the asset or the real estate.
Sure.
So what we did is we purchased the property and we're converting it into 23 apartments. And so, we are going to create 23 places for families to live in Santa Barbara that otherwise didn't exist before. So on the positive side of things, you're creating housing. Just from a social perspective, you're creating housing. We have a few affordable units in the project, so we're creating some affordable housing as well. It's a great location for people to live. But then on the financial side of things, housing is the highest and best use in this particular location. And even though it was, I'll call it painful, to say the least, to get through the permitting process with the city.
I was just about to ask.
Even though that was, that's a process in and of itself. At the end of the day, it's going to be a very financially exciting project, because someone's going to want to own this asset. This is going to be a trophy for someone to own. It's going to be a 23 unit brand new Class A apartment community in a dense urban area that didn't exist 2 years ago.
So, here's something that I find really, well, I guess the first question is, what were some of the biggest holdups with the city, right? Because going through a project like this, in this case, an adaptive reuse project, right? You're going from office to multifamily.
Yep.
You're leveraging the density bonuses that,
yep,
that California is pushing right now. What were some of the biggest challenges that you had to overcome, with the city first off, right? And then, of course, the project has its own set of challenges. Typically, when you're getting through it, nothing goes exactly as planned.
Oh.
And so you have to kind of make adjustments along the way. So can you talk to that a little bit?
Well, first of all, I have to give a shout out to my partner, Dan Kennedy, who has really spearheaded this project for us. He has really been the one day to day pushing things through. And maybe it makes sense for you to speak with him. He's actually, he'd be an engaging conversation for you. But the process with the city is, you have risk because the city has ordinances that are, I'll call it written in pencil, and are changing, or at least are being changes are being discussed. And then you have a city that is very well known for being difficult for developers. Even if just thinking about a simple permitting project, even if you own your own home and you want to, remodel your kitchen or put in new windows or repair your foundation, could be a 12-month process just to get through permitting to get it done within the city's regulations. So it's time consuming and challenging. However, this project was met with really positive reactions from the city because of what I mentioned, especially from the social good perspective. We're creating housing. The city is in a housing crisis.
Sure.
So they're loving, this adaptive reuse, and they're actually hoping that other developers will follow and do more of this. I'll give you a quick anecdote because I think this is where you were going.
Yeah.
We debated. So we had, we're at the very end of the process. We have the landscape architecture review meeting. We debated with the board about the placement of a single agave plant in the landscaping for about 20 minutes. And this is at the very end, like everything's been approved. This is the final kind of last thing. And so that's the level of detail and scrutiny that a project like this will attract. But that being said, the bigger, there are not that many developers or let's call it real estate investors that would be equipped to take on a project like this and succeed. So once you can, the bigger the problem that you can solve, the bigger the opportunity that you have, and the less competition. And so we're just really thankful that we are in a position where we're going to have a successful project here. But yeah, it was not without its blood, sweat, and tears.
Of course. So, as the markets start to evolve and change, right? We're going through right now some evolution with COVID-19. Where do you see the opportunity? I mean, you talked a little bit about, what you're pursuing in this market, why, how you are moving your company forward, especially with private equity, right? And looking for markets with good risk adjusted return opportunities.
Yep.
But, you know, in this market where things are evolving, where do you see opportunity, right? You talked about Santa Barbara, one market, you know, you and I talked about Milwaukee for industrial product.
Yep.
But how are these changes changing how you think about opportunity, right? How are the economic changes shifting how you think about just various opportunities, right? Especially for your investor base.
Yeah. I mean, you have to, as an investor who is a fiduciary with someone else's money, and your job is to maximize the return of the project, and to go find somewhere to place capital that you're confident in. You know, you really need to be considering these, what I'll just call these kind of macro components. You need to understand where you need to have a thesis, at least, on where interest rates are going to be going. No one knows, but you need to have a thesis.
So let's hear the thesis, Matt. Let's hear the thesis, man.
Well, let me say a couple more, and then I'll jump in.
Right.
You need to have a perspective on the political environment. You need to have a perspective on demographic trends. And, you know, you need to be critical, and you need to be willing to revisit your assumptions and change your mind, you know, because there are things in the outside world that you have no control over. And I think of my job as an investor to understand what's going on around me, and identify the opportunities that have the highest return potential for taking on the least amount of risk. And some projects are going to have higher risk, and therefore they should have a higher return profile to compensate for the risk.
Right.
Some projects are going to have lower risk, and therefore they're likely going to have a lower return profile as well. In terms of interest rates, I mean, I think we're in a pretty low interest rate environment for the foreseeable future. You know, I can't envision today the moment that interest rates will raise. And the Fed is certainly posturing, you know, that there's going to be a long, we're entering a period of very low interest rates for a long time. Not only has Jay Powell essentially said that, but they just announced that they're now pushing for, they're no longer, they're going to allow inflation to potentially run above 2%, which would be meaningful, and would. In the short answer, I don't think interest rates are coming up anytime soon.
Okay, so there are two sides to that sword, though, right? Because, you know, anytime you start talking about the Fed, and you start also having conversations and projections about interest rates staying low, really what you're saying is we don't expect a lot of growth moving forward. Consequently, we need to stimulate that as an economy, right? So there's always two edges to that sword. I think one of the unknowns, especially in a market like this where you just have so much capital being injected into the economy by the US government, is in theory, real assets tend to benefit heavily in markets where you just have a lot of government, where you have a lot of government subsidies, right? Government spending. In theory and historically, real assets have benefited from that spending, right? But in a market like this where you just have, I think, you have a lot of jobs that are going away.
Yep.
And you have a lot of jobs that are not coming back. I think people are, I think maybe in some degree, underestimating what that's going to look like long-term, right? And what I think is that's the reason for keeping interest rates low, is to help offset the massive job loss that we have had and that we're likely going to continue to have. Because here's what a lot of people don't talk about, right? And from 2008 to 2020, January of, you know, it took us 10 years, 2008, 12 years to create 5 million jobs, okay, to get to 3.5% unemployment now. You know, there are a lot of arguments about how accurate that rate is, and I'm not going to get into that. But the point there being is 12 years, right? 5 million jobs. And we lost 20 million in a period of, I mean, just a really short amount of time.
Yeah.
And my guess is 25% of those jobs are not going to come back, right?
Maybe
I really appreciate your viewpoint. But I just find it fascinating how a lot of people are not talking about jobs. Rather, the conversation is shifting to interest rates. and I just find it fascinating, man. I mean, this is now my third cycle, and I just find it fascinating.
So I don't disagree with you at all.
Psychology of money, right?
No, I don't disagree with you at all. But the one thing that I think about is interest rates are they're set at at least the Federal Reserve sets rates at a federal level. Jobs, the headlines will grab jobs numbers at a national level. But what's more important to me as an investor, just purely as an investor, is jobs in my market or a market that I care about. So if you have a combination of low interest rates because the country as a whole is struggling, but then you have a market, let's say Huntsville, Alabama, small market, growing very quickly, diversifying economy. If you have a low interest rate environment, but then you have a market that doesn't necessarily have the characteristics of the country as a whole, it has better demographics. More people are moving in, more jobs are being created, fewer jobs are being lost permanently, incomes are rising. That's a really interesting disconnect, which we look for. And you can take advantage of a low interest rate environment in a market like that. You can't just blanket statement say, well, interest rates are low. And also jobs we've lost a net, 11 million jobs over the last 6 months. And they're not going to come back. I think that's a little bit, to me, that's too broad strokes of a view. I like to look at the macro headlines to understand what's going on nationally, but then dig into a specific market to see what's happening at the local level. We all know you can make an investment in the same market and be on two sides of the same street, and you could have drastically different outcomes. Right?
I agree with that. So let's use your example so I can clarify what I'm talking about, okay? So anytime I hear the word risk-adjusted return, it always piques my interest because I've never seen that term communicated the same. If I take 10 people and I sit them in front of me and I ask them, what does that mean? I can promise you, no one will give the same answer.
Yeah. Because
it's relative, right? For one, and two, it's subjective. Okay. Yeah. It's subjective. You cannot price that. There are pricing models out there for that in theory, right? Created by Wall Street, and they're just not accurate to begin with. So you can't price that down to a science. But let's use your example, okay? So let's use your Alabama example, and then we'll throw your theory of risk-adjusted return in there, just so that the audience can see how this stuff works, right?
Sure.
How subjective this is, but this is why we have opportunity. This is how you create a market, because you have opposing views, right? Yes. And somewhere inside of that difference of opinion is opportunity, and that's what I love about this country. So let's use that example, okay? So Alabama. Say Alabama is a market that gets hit harder than Santa Barbara. In theory, that should be the case, in theory, right? But then the other side of that too is if you're a company pursuing risk-adjusted returns, in theory, there should be higher cap properties in that market, right? Because there's more disruption. There should be higher vacancy. So consequently, there should be opportunity that we can pursue with higher yields, right? In theory, okay? Now let's come back to Santa Barbara. So in Santa Barbara, the opposite of that is true, right? You're taking on, in this case, 5 to 6, in some cases, 10 times more risk. And let's use your 23-unit apartment building as an example, okay? Now, I don't know what the metrics look like, right? And I don't know how you capitalize that project.
Yeah.
But say you purchase the office building at a 6 cap. Right? Because apartment buildings there are trading at a 3. Okay. And now you're going through this conversion. Okay. And you're gonna increase your cost basis by quite a bit because you're converting this now to an apartment building, right? You have entitlement risk because of the city. Okay. You have construction risk. So when it's all said and done and you finally build this thing out, get this product fully leased, you're probably looking at what an all-in cap rate once leased up at maybe 4%, right? Somewhere in there.
Yeah.
Okay. So let's think about this, right? I purchase a product that's stabilized in Santa Barbara at a 3 cap because that's historically trading really, really low. Now I take on all this risk and I gain 100 basis points.
Yeah.
Okay. That's what I mean. Now let's look at Alabama. So I'm dealing with vacancy. I'm dealing with more product uncertainty or more market uncertainty. I'm dealing with more uncertainty in the job market. The other side of that too, though, now I'm also have the opportunity to capture that in higher cap rate, or in the conversion of that as higher yield, right?
Right.
Okay, so say that's 8%. Now, in my case, the biggest risk that I have to manage is my greatest exposure is going to be my ability to manage from out of state, right? So in my mind, what I have to do is dial that in. I have to figure out how to be able to manage from anywhere in the nation, anywhere in the world, so that I don't give up that yield, right, for the additional risk that I'm taking. But anyways, the point there being is I'm just trying to elaborate on the fact that, risk-adjusted returns, man, they look so different depending on who's articulating that and why they're articulating it. I don't think one is right over the other. And I'm so grateful for you expressing that. And I understand what you're communicating. I'm just trying to show the audience that ultimately what they're paying for when they come to people like you and I to help place capital is our ability to figure that stuff out, right? Yeah. And to manage through challenge, to manage through chaos, and to make decisions that are going to reflect those really making decisions that are going to reflect our ability to manage through those challenges and execute. That's really what people are paying for. Would you agree with that?
Yeah, I would. Absolutely. And there's so much that goes
fascinating, right?
Yeah, no, and there's so much that goes into, determining your risk profile and determining
man. 100%.
where you think the risk is, that it can't simply be thrown into a math equation. There's some art to it. And, you probably should start with some data, and then you probably should go visit.
That's a good place to start, right, Matt?
Probably should start with some data, and then you should probably go visit some markets, and you can get a pretty good feel with a few visits and talking to a bunch of people. And when you have, when the story is strong data, strong intuitive feeling while there,
right,
strong verbal feedback that is validating your hypothesis, or validating your understanding of the market from third parties, disinterested third parties. That's a pretty strong, to me, sense that you're on the right track.
So here's the other side of that too, right, Matt, that I find really interesting. And I'll share the background of the story that I'm about to share with you, or at least the perspective. Okay.
Okay.
Because it's really fascinating to me, man. And this is why I love having conversations with many people in this business, especially if they're experienced and they're buying and they're investing, and more importantly, putting their own money at risk, right? Because 3 weeks ago, maybe, I was on a call with a friend of mine, very sharp guy, and private equity firm. They focus on, or they specialize in the Texas marketplace, and we're actually looking at a deal right now that I'm looking to place quite a bit of money in, and and take a preferred equity position. Okay. Mm-hmm. But the question that I always have when I'm being presented with an opportunity to invest and they're quantifying the risk associated with that transaction, and then of course pricing my returns, I always ask, well, if you take my capital out of the equation, because you're the one quantifying the risk adjusted return, right? Okay, but my money's going into the deal.
Right. So
if you take my money out and you put your money in, how would that change? And the guy got really quiet. So we both started laughing, but he got the point. And I also just find it very interesting because there's always a psychology behind money, right? So now let's look at your example, because man, you gave a great example of this adaptive reuse, office conversion product, right?
Yeah.
So when we're looking at that, say your exit is now, when this thing is, you're all in after building this product out, leasing up, now you're at a 4 cap, right? So in theory, you're selling out at maybe a 2.5 or 3. I don't know that market really well, but I would have to think there's at least 100 basis point spread there, even to justify the risk, right? So, but for a product like that, you would have to sell. And I even heard that in your language. So now you sell out of this, you go through all the time and energy, right, to create this upside, you sell out. And my question is always, now what? So if you're spending a lot of time developing these trophy asset opportunities, but and when I say you, meaning we, as investor operators, we put ourselves in a position where we have to sell out of those positions. Okay, then what, right? I mean, then what?
Well, so for us, for this particular asset, we will go look to do a 1031 exchange.
Okay.
And ideally we can find another asset that we can execute a similar plan on.
Okay.
I mean, the life cycle of an investor tends to be, a real estate investor in particular, tends to be active, high risk, at the front end, active, high risk, lots of different opportunities. They may not all look the same. And as you progress, it tends to turn into more passive, lower risk, more interested in yield, less interested in upside. Don't really want to think about it at all. I just want to collect my check. And so, right now with our business, we're in the front of that, we're at the beginning of the cycle, of that kind of evolution.
Sure.
We're looking to go create value. And for us, someone generally on the tail end of their investing career is going to be more interested in acquiring the value that we've created, because they're going to be willing to pay more for it. And we are going to go look to recycle that capital and go execute a similar plan and try and quickly build the basis of cash that we have and that our investors have.
Sure.
That's what we'll go look to do for this deal. We're going to do a 1031 exchange on another deal that we're going to close. We're going to sell this year. And so that's what we look to do, is go recycle capital. If it's a value add play, once you've added the value, you need to extract it somehow, whether that's through a refinance and pulling out cash, whether that's through a sale. So generally, whenever we have a value add deal, we need to feel confident that we're going to be able to execute one or both of those plans. Generally, in Santa Barbara, it's generally going to be a sale, because a refinance won't, because of debt service coverage ratios, a refinance won't typically allow you to pull out the same capital that you would in a sale. So that's
not with that kind of cap rate. Yeah, no, I see that.
No,
I see that. So let me ask the question a little differently, right? At what point does it make sense not to sell?
Yeah,
because here's the reason why I say that. Okay, there have been times where, man, I bought product or property, real estate, and in most cases now, what we keep in our portfolio, we just cannot replace. Very difficult to replace the kind of returns that we're getting. And internal rate of return, there's a timestamp associated with that, right? The longer you go out, okay, the numbers tend to drop because of the time value of money. But at some point, if you're buying assets correctly, or you can even get lucky, which I have. Okay, I'll maybe use that terminology as well, just for the sake of humility, because this business can humble you pretty quickly.
Yeah.
Sometimes there are certain assets, when you do the math, even when you think about rolling that into something else, very difficult to replace those kind of returns, right? Very, very difficult. And in many cases, my partners have really understood that extraordinarily well. But there are other things that I do to help, create some enhancers in there so that, that money is still going to work that value is being captured, but then we're still creating other opportunity for our partners, right? So for you, at what point does it make sense not to sell?
I think you said it, is you need to weigh the return that you're getting and the risk that you're taking by holding the asset that you have against what return is available in the market, and what risk are you going to take on to go try and achieve that return. So there's this constant kind of balancing. With our business plan of heavy value add multifamily deals, there's generally always going to be opportunity. You know, that doesn't mean there's tons of inventory. Right now there isn't, but
right.
we're very opportunistic in looking for it. And so, you know, that's how I think about it, is exactly what you said. Can we replace and improve upon the return that we're getting today? If we can't, then we should hold the asset. If we can, then we should go look to transact and go do it again.
Sure. No, I like that. I like that. Very, very interesting, right? So I always love the topic of, I just love these topics in general, because usually very rarely does everybody look at opportunity the same way, right? Yeah. You might look at an investment like a asset class very similarly, but the thought process behind how that money is put to work usually varies a little bit. And to me, it's always very, very fascinating. Well, man, we are at the end of our show. And Matt, you've been a tremendous guest. This has been a very unique conversation, right? Because of your experiences, we're able to get into depth a little bit more. And I think, you know, in this case, really a great conversation for our audience, because, you know, you're covering a couple of different viewpoints, right? You're covering that of owner operators, which we have quite a few folks that tune into the show who are experienced operators. And the other side of that is experienced investors, right? Really experienced passive investors.
Right.
And so I think, you know, you've done a great job of giving them rather, just different perspectives on how to assess risk and the reward associated with that risk. And I think you guys do a great job of that. So if you were to trade out of this, which it sounds like you're going to, okay, and this is the last question, where do you see yourself placing that money? What product type, what market? You know, I know you love Santa Barbara. There's some other markets in the Midwest that you've communicated to me that you appreciate more than others, but where do you see yourself trading that equity into?
I think in this particular deal, we'll look for another opportunity in Santa Barbara. You know, the investors in this deal understand that market. They've raised their hand and said that that's the profile deal that they like. You know, we'll try and honor that by finding another deal that looks substantially similar. And if we can, we'll take it on. And if we can't, we'll return capital. And our investors will be, you know, they should be pretty pleased with the outcome. You know, there's not a bad answer, right? There's not a bad outcome.
Correct.
Because we've created the value. It's simply a matter of, can we find an opportunity at the right moment that makes sense? And I think it would be in Santa Barbara for this particular deal.
Yeah, man. Awesome. Well, I really appreciate it, Matt. You've been a great guest, man. This has been a really fascinating conversation to me. And I know to a lot of other people. So I'm going to summarize really quickly. Okay. So one of the things that you talk about when we first had this conversation was, you know, one of the big things that you walked away from Facebook with that you've been able to apply to this business is just thinking bigger, right? And I found that comment really fascinating. And it's really apparent that you've been able to apply that to this business because of the type of product and projects that you're involved in. Then you talked about risk-adjusted returns. We had some, I think, just a great conversation around that, right? Because, you know, one of the things that I love about that topic is, you know, anytime I ask people that question and I ask them to elaborate, the conversation, it's never consistent, right? Everybody looks at that a little differently. But because of that, I think it's also a reflection of how much opportunity there is in this market, because if everybody looked at that the same way, all the opportunity would get competed away, right? And fortunately, that's not the case. Then you shifted into discussing just your investment profiles, what you're looking at. One was industrial product in Midwestern states. And the idea there was to drive and capture higher yield. And then the other profile of an investment opportunity that you're pursuing is multifamily real estate in high density markets, right? Low cap, low vacancy markets, in this case, like Santa Barbara.
Yep.
You're doing an adaptive reuse project, which you use to highlight the extreme value add component of that, right? Which I thought was a great example, man. And in that case, you spoke to the heavy value add component of your strategy. So Matt, I want to thank you, man. This is, I think you've been just a very gracious guest because, we kind of got into a lot of meat today and some details, but that's the stuff, man. I always say that the money is made in the details, right? Yeah. The money in this business is made in the details, especially in markets like this where, to your point, there's just a lot of uncertainty. I like to say really that there's more, a lot of confusion. Mm-hmm. And I think you've done a great job of expressing or sharing some ideas and some strategies that you're employing to help capitalize on, on that dislocation, or in this case, to help capitalize on just the fact that there's a lot of confusion in the marketplace, right? So thank you so much, man. You've been tremendous. Before we have our audience share, or you share with our audience how they can get a hold of you, I always like to ask this question is, what is the one question, Matt, that you have for me that you think can add value to our audience?
Oh, that's interesting. Okay, here's something that should be a layup for you, I guess. Okay. You're an investor. You're looking critically at opportunities today.
Right.
You also labeled yourself a contrarian, which I like. Tell me where, from a risk perspective, given the uncertainty, the confusion in the world right now, what is off limits to you today as an investor that maybe used to be something that was interesting to you, an asset class, a location? What's off limits today that was potentially in your sweet spot, or at least you were considering, sometime ago?
Sure. I really have learned, Matt, over the years, never to say never, right? I mean, that's been one of my big learning lessons. And I'll just really briefly share the story. So in 2008, 2009, when I transitioned into this business, I used to be a commercial banker, went all into real estate, right? I told my wife, I said, look, we have to go all in now. If there's anything that I learned in banking is that 80% of our wealthiest clients, nearly 90% of that wealth came from real estate. So we got to go all in right now. And my wife, commercial real estate appraiser, she understood that. We both are real estate folks. And fortunately, she trusted me enough, especially with an 8-month pregnant baby. And this is our second daughter. And we just moved into a new house, right? So most of our savings was depleted. Fortunately, she had enough faith in me to say, okay, and these are her exact words, okay, now you can go do what you were meant to do, right? Those are her exact words. So I love my wife for that, for many reasons. But one of the big lessons that I took away from that marketplace was, we were doing a lot of business, but we could have done much more if I aligned myself better with people that had a different specialization than I did. Yeah. Because, there is a lot of truth to creating, to focusing on what you're good at and to creating specialty. But that doesn't mean that you can't participate in other opportunity with other people that just have, or companies for that matter, or groups that tend to specialize in that product more. Yeah. So an example of that, for instance, would be, let's use your adaptive reuse project, right? Or self-storage. Self-storage is a really good one. Okay. I love that product type. Okay. But I don't want to spend a lot of time trying to relearn that. Right. So if I can call my buddy who I know does that exclusively and has spent the last 30 years doing that, and I bring him into the deal, for me, that's a great opportunity. Now, in 2008, that cycle, I really wasn't smart enough to understand that. Now I do. So, and that's one of the reasons why, I love having conversations with folks like you and understanding how you think through things and where you look at opportunity, because you're one of those folks now that I can call on and say, hey, Matt, I'm looking at this thing and I like this, but I'm tied up in these projects here, but I think this is a good opportunity. Can you look at this and tell me what you think, and where do you see the opportunity? And is there a place for us to participate together in this transaction, right?
Yeah.
Okay. So that was my biggest takeaway. So I've learned never to say never. Now, here's where that changes a little bit, okay? Because we live in a world where time, energy, and money are not infinite, right? So I've also learned that I have to really be wise about how I spend my time, energy, and of course, my own money, but predominantly time and energy.
Yeah.
So you gave a great analogy in that you are really quick to build a pipeline, and through several discussions around properties in your pipeline, you're able to quickly at some point narrow down where should we spend the most of our time and energy, right?
Right.
So out of every 10 deals, or in this case, 30 deals, you're going to say, okay, I'm going to spend our time and energy on these 3. And ideally we take down 1 of the 3 or 2 of the 3 or all 3, depending on how they turn out, right? Yep. Okay. So I go through a very similar process. So with that being said, the one thing that I will not pursue right now, okay, will be special purpose product, like gas stations. Okay. That I will not pursue. I've done a couple of those in the past with some friends of mine that's all they do and all they specialize in. But I really shy away from that stuff. Things that are so specialized that, they become the risk profile for that product just becomes too great for me where I am right now. And I think there's just too much opportunity there. Right.
Yeah.
But for retail, for example, I know a lot of folks are shying away from retail, but to your point, in California, a little bit different because the mandate right now is to create housing.
Yeah.
And so I think what you're doing is very wise, as long as there is an alternative use for that product type that can fit in that market, and that use is higher than what the current use is. And we're not going to take too long to get through that. And I can align myself with people that can help improve the return on my time and energy, then man, I will do it all day long. So hopefully that answers that question. I've just learned to look at things a little bit more objectively at this point in my life, but I also know when not to spend a lot of time on something if it just has too much risk associated with it. In other words, if it's just too specialized, right? If it's just too specialized, man, I just won't get into that. But
cool.
That's how I approach opportunity.
I like it.
Yeah. So thanks for the question, man. It was a really good question. So Matt, thank you so much. But how do people get in touch with you, man? Can you please share the best way for folks to reach out there if they want to learn a little bit more about your private equity firm, what you folks are doing, how you're doing it?
Yeah. And thank you so much for having me, John. I appreciate it. It was great to speak with you. So Matt at drivencap.com, drivencap.com, CAP as in Paul. Drivencap.com is our website. Driven Capital Partners is the business. It's myself and my partner, Dan. And please reach out. We'd love to have a conversation with anyone that's interested.
Awesome, buddy. Thank you so much, Matt. And I wish you continued success, man.
Hey, likewise. Thank you. Appreciate it.
Thank you. Clarity of purpose creates our greatest competitive advantage. When we transform apartment buildings to thriving communities, we improve how people live and create assets with high profit margins. Don't forget to subscribe, like, and share this up with a friend. I'm John Brackett, bringing you things you can implement right away.